What's up, everybody? Josh Bennett with Money Masters, the channel where we help you earn more, keep more, grow more money. In this video, we're going to show you exactly how, if you are a millennial, how you can become a millionaire just by doing tax-efficient savings. So there's a lot of misinformation out there when it comes to different retirement accounts. So you may have heard the term Roth IRA versus traditional IRA. Or Roth 401k versus traditional 401k. So there's a big difference between theirs. A lot of the general, good financial advice is to use your 401k as your main retirement savings vehicle, and that the sort of advice around that is that your tax level should be higher today because it's your peak working years, and then in retirement you don't need as much income. So your income is going to be lower, so you're going to get taxed at a lower rate. I'm going to show you why that is wrong. So for anyone that is young in age, you should highly consider a Roth IRA or a Roth 401k. And before I go into exactly why that is, I think you should understand what the difference between the two are. So a 401k and an IRA are very similar in terms of just their overall functionality. So they're both different retirement accounts for saving for retirement. So you can't necessarily access them until retirement age. The government gives you an incentive to save for retirement in these accounts that you can then access later on, and they give you tax incentives along the way to incentivize that savings. So a 401k allows you to contribute right now $19,500, and that's associated directly with your employer. So an IRA is an individual retirement account, not associated with an employer. Anyone can open an IRA. You don't have to have it through your job. And through an IRA, you can contribute up to $6,000 per year. So whether it's a Roth IRA or traditional, those are the two different income limits that you can contribute, or the different amounts you can contribute to those accounts. You can do both of them combined. So altogether, you could do $25,500 and this is all assuming you're under the age of 50. You get actually some bonuses when you turn 50, but for now, we're going to assume you're under the age of 50. So with this there's different tax incentives between the two different, whether it's traditional or Roth. So how a traditional account works is you get a tax deduction today, meaning if, say, you have a $100,000 salary, you contribute $20,000 to your retirement account. Well, now for tax purposes, the IRS only looks at it like you have $80,000 of taxable income. So it's a way to save kind of $5,000, $10,000 in terms of taxes today. Then once you contribute all that money to a traditional 401k or IRA, it grows tax deferred, meaning you don't pay taxes right away, but then in retirement, when you take that money out, you will owe taxes on it at that point. So it's taxed as income then. The other downside with the traditional is that at some point the government's going to say, all right, we've given you enough tax incentives. Now Uncle Sam wants his cut. So Uncle Sam's going to come in and say, you are required to now take money out of this account. And we're going to give you the variable for how much you have to take out each year. And that variable starts at kind of 72 with the idea that, the way they calculate it is that hopefully, from their perspective, that account is zero the day you pass away. So that's the traditional. The Roth is the exact opposite. So Roth, basically, you put money in after you've already paid the taxes today. Then, as long as you meet all the requirements, you put that money in, it grows tax-free, and then you never pay taxes on it again. So you get no tax deductions today, and it's actually going to make things tighter in your cash flow because you've already paid the taxes. So if you contribute $6,000, well, that really costs you more like $10,000 to be able to contribute because the taxes came out of there too. So again, a little more pain to do the Roth today versus the 401k, but I'm going to show you why it's important to do so. So let's take a look at this. So this is our calculation. So over here, and what we did was we tried to actually put this in the most beneficial way for the traditional IRA, or traditional 401k. So the idea here is this is the traditional, this is the Roth. So what we assumed is that just to keep things even, say you had $10,000 going to the Roth, but $4,000 of that went to taxes, and then you had the $6,000 going to the traditional. What we assumed is the tax savings that you got from the traditional, you actually reinvested that too. So you're actually kind of getting the double whammy with the traditional. So if we look at that, so we factored in age 30 and a retirement age of 68. So, and then assumed kind of different, like a 9% calculation, and we can play around with the tax rates. But all in all, if you grow your money and you invested the difference in taxes as well as used a traditional 401k or traditional IRA, the Roth would still come out ahead. So you'd still have about $1 million more in Roth. If you didn't reinvest the taxable account, you would have about $3 million more in Roth. So even though you're paying more in taxes today, and it's a little more painful today, over the course of a career, just the way compounding interest works, you're going to save hundreds of thousands, if not millions of dollars on taxes alone, just by using a Roth IRA or Roth 401k instead of a traditional. So again, so like if we look here, this is assuming basically we did that full 401k and IRA. And if you're married, you can essentially double this. So let's just say it was 50,000. But I mean, the difference gets even more dramatic when you're talking spouses. So Roth would be, say, 18 million, where regular would be 13 million. So $5 million difference just by using the right account. So that, again, it's not even fair when you kind of compare these two things. And so the other thing to point out is that some pushback would be, well, the tax rates might be different than what I'm assuming on here. But the big factor is, even if you use a traditional IRA, remember that I said the government's going to force you to start taking money. Well, your first year RMD, or required minimum distribution, will be $1 million. You're going to have a high tax bracket with $1 million. So even if you probably have a higher tax bracket with that $1 million than you might have today, because that's what the IRS is going to require you to take out and get taxed on. So long story short, there's a lot of financial gurus out there that will say, use the traditional 401k or traditional IRA because it's the better route. But when you factor in taxes, it's really not the better route. And so Roth IRA for most millennials is going to be the better option for building long-term wealth. So hopefully you found this video really valuable. But again, just make sure you kind of factor in all the pieces and the variables that go into saving. And taxes are going to be your biggest expense throughout your life and career. And that's going to be the biggest thing that's going to take away your wealth. So make sure you're minimizing that as much as possible to grow your wealth. But until next time, cheers.